Good afternoon and welcome. It's wonderful that you can join us today. My name is Andrew Bradley, and on behalf of the Chrome Wealth Associates, I'd like to welcome you to our annual investment and financial planning update. With me today, I've got Bernard van Wyk, the Head of Investments at Analytics Consulting, and Nadine van Taak, the Senior Investment Consultant at Analytics Consulting. Both of them assist us in putting together the Chrome investment strategies. Bernard's going to look at the investment environment and outlook, and Nadine will then look at a few burning questions facing investors right now. And then I'll finish off with a financial planning update. It must be said that at a time like we are currently experiencing, it is difficult to talk about being positive about the future. However, the very essence of our future depends on it. We have to find the positive and work hard to ensure that we progress towards it. That may be a difficult task for some and even impossible for others. Not a day seems to go by where we're not exposed to some atrocity or another. The ongoing war in Ukraine rightly still receives a lot of attention, with all the devastation of people's homes, workplaces, families and lives. Not to mention the ravages of war, the human rights abuses, and the theft of food. All these are enough to question the trajectory of our future world. While all of this is horrendous, what has certainly startled me even more is the footage of a number of scenes of physical and related abuse of women in China. It is challenging to watch, and even more incomprehensible to believe that this behavior seems to go mostly unpunished. We also have a multitude of seemingly never-ending tragedies as a result of gun violence in the US. Then, on top of that, we have the ongoing effects of climate change, with flooding on the east coast of South Africa, rampant fires across the US and Western Europe, with droughts in Sudan and many parts across Africa, with the resulting food shortages and starvation on the rise. This is not a pretty picture in any way. Is this an aberration, or has humanity lost its way? Is this our next normal that we're going to have to deal with? Well, I'm now going to hand over to Bernard to try and put some of this into perspective. Thank you very much.
Right. Thanks, Andrew. I've got a couple of slides today to just discuss the environment we're in currently. It's obviously been quite a volatile period the last 6 months. Coming out of COVID, economies opening up, we saw an uptick in inflation numbers, and that was driven predominantly by a pickup in growth activity. So we call it good inflation. It's inflation that's driven by economic growth and improved economic environment. But that also started to spill over into concerns about the growth outlook. And what really triggered that was obviously the conflict in Eastern Europe. It brought into context how sensitive the global economy is for different sources of energy and gas and food prices. So where we went from good inflation, the market has gone to what we refer to as bad inflation. It's inflation that's triggered by a supply shock. And what you can see is the impact on markets. The graph here on the left is just the global equity market. And you can see that the market peaked around about early in the year, around about January, 4th of Jan, and it's declined by 23% already. And remember, when you look at equity markets, essentially the price and the share prices is a reflection of where investors anticipate the earnings will be of companies. So a decline in share prices is effectively indication that investors anticipate a fall in earnings. And that's what we're trying as an investment team, trying to establish is to what extent will earnings come under pressure, and to what extent is the market overreacting, or is there potential more movement? But what we've experienced this time around is also negative returns on the fixed income market. And the graph on the right is showing you the total return from global fixed income assets. And you can see the big movement. Again, it's almost down by 20%. And this was driven definitely by the impact of higher interest rates. So we saw long-term interest rates starting to increase. And this is now why investors is also getting concerned about the outlook for growth. From a portfolio perspective, just very briefly, I just want to show you, this is perhaps a bit of a busy graph. What I'm showing you here is the returns on fixed income investments and equity investments in the dark blue. And it's showing you the return over 12 months. And we measure that at the end of every month. So we roll it forward a month and we look back and we assess what the return was over 12 months. And what you typically will see is when equity markets historically has been under pressure, so when you experience a negative return over 12 months, you had some protection from the fixed income market. So you always had a bit of a defensive asset in your portfolio. During the global financial credit crisis, you can see there was a movement where they both declined. And now this time again, we are experiencing a period where both markets are actually declining. So that traditional benefit of diversification in a portfolio is currently not working. And that is as a result of a growth and essentially an inflation concern in the markets. So what is causing all of this angst in the market? It's coming down to very high inflation, as I mentioned. And to bring inflation under control, typically you see central banks starting to increase interest rates. So the graph here, this is from the St. Louis Federal Reserve. It shows you going back until the 1950s. It shows you in dark blue the inflation number in the US. So you can see where inflation peaked in the late 70s. And then you can see the light blue line is essentially the interest rate in the US. We call it the federal funds rate. And typically, as inflation starts picking up, you see the Fed starting to hike interest rates to cool inflation down. The risk normally associated with this is that interest rates is hiked too aggressively and the economy tips into a recession. And this is the gray bars you can see is a reflection of periods of where the US economy went into a recession. And you'll be hearing a lot in the news about a hard landing and a soft landing. Essentially, a soft landing is referring to a period where the Fed can increase interest rates without triggering a recession. It's essentially only happened once before. You can see here it was in '94 under Greenspan. They were able to hike interest rates, but there was no recession during that period. So interest rates currently is extremely low and the inflation is very high. And the market is basically trying to figure out by how much do we need to push up interest rates to bring inflation under control. It's a difficult question for the Fed because some of the inflation numbers obviously now has been triggered by supply issues. Some of the inflation numbers is a result of sanctions imposed on Russia in terms of commodity and energy exports. And then there was inflation driven by the recovery from COVID. So the Fed needs to figure out which of these inflation numbers are sticky and which of them will actually just unwind over time. So if you look at the basket of inflation, remember inflation measures essentially a basket of different services and goods. This is the makeup in the US. You can see inflation is close to 8%. And then if you look at the bar chart, you can see the gray one is the makeup of energy. So energy makes up quite a big component of the US inflation basket. And we know what's been the cause of the higher oil prices, obviously with Russia being a main oil exporter. But it's not just the oil price. I think what we need to realize in the US, they've got refinery capacity problems. So they have sufficient oil, But during COVID, they've closed down a lot of the refineries that takes the crude oil and converts it into gasoline and diesel. And a lot of these refineries is not opening up because they anticipate that the move to electric vehicles in the future will mean a less demand for fuel. So there's a tug of war in the US currently by the politicians trying to get refineries to open, but the investors is not willing to invest the capital to open up many of the refineries. So that's why you're seeing very high very high diesel and gasoline prices in the US. If you look at the food prices is also accelerated. Again, Ukraine is obviously a main exporter, as is Russia in terms of wheat. But then also transporting food, there's a second round effect of the higher gasoline and oil prices. I checked this morning, if you look at the wheat prices in the US since the start of the year, it's up more than 50%. Those of you who've been in the States, I see that the prices of eggs have increased by 150% in the States over the last 12 months. So there is definitely substantial food price inflation. The third one that we think might be temporary is on the motor vehicle. So Americans obviously love their vehicles. And the main reason for this is supply chain problems, and especially semiconductors. So these days, obviously, there's a lot of technology in vehicles, and we've had shortages of semiconductors. So a lot of vehicles can't get completed because they can't get sufficient semiconductors to complete the software and the electronics in these vehicles. So you can see how that light green bar, how it's actually increased from January 2001 to where it's now. Then if we look at the more sticky inflation, you can see essentially it is the core goods, excluding vehicles, and then the core services. So this is your day-to-day goods that you use, and also the services. And you can see essentially that's typically been drifting up. Coming out of COVID, it's accelerated. And this is much more difficult to bring down. And this is where interest rates will probably have to do the heavy lifting. So trying to cool down the consumer spending in the US, which is still very healthy. The big one, though, obviously, is house prices. So you can see back in 2001, house price inflation made up less than 0.5% of inflation. And now it's almost 1.5%. So a big increase in rentals. Obviously, what happened was low interest rates meant many people bought speculative properties or second properties as investments, pushing up the prices, squeezing out the first-time homeowners out of the market. Those guys went back into the rental market, and that resulted in very high rental to be paid. So this is the inflation outlook. And the question that the market is trying to anticipate is, how will these little bars look 12 months from now? Will they come back into an acceptable level? And how much do we need to push up interest rates to make sure that inflation gets back? The Fed is talking about getting back to 2% inflation. We think it's probably going to be somewhere closer to 3% at an acceptable level. At this stage, it looks like the market is anticipating a further 2%, 2.5% short-term interest rate increases in the US. If you look at why we say the inflation is going to be sticky and might be actually higher for longer, this graph, what I'm showing you is, again, the light blue is interest rates, and the dark blue is the impact of essentially of rental income, so shelter in the US. So that's your inflation being driven by housing. And what you'll notice is the effect of higher interest rates takes time to flow through to the housing market, because you first need to bring down house prices to get the homeowners, the first-time homeowners, out of the rental market back into the physical owners. So it takes time. We've only seen the interest rate cycle starting to increase now. So this needs to come down, and we think it's going to take slightly longer. So we think inflation pressure will potentially remain with us. But we need to understand where that will play out in our portfolios. Just for interest's sake, I'm just showing you the inflation numbers from food prices. You can see how it accelerated. It's the highest it's been in 40 years in the US. So, I mean, that is definitely putting a lot of pressure on consumer spending. I just want to say that consumers obviously is much healthier than there was prior to COVID. So a lot of questions then from investors, and a question that we try to answer in our investment committee meetings is, how much more can the market from this levels tolerate in terms of price movements? So when we look at valuations, this is the graph on the left. This shows you the price to earnings multiple. Very simplistically, it's telling us how much are you paying as an investor to become an owner of earnings in the market. So over the last 20 years, you were paying 15 times. So if you want to be an owner of $1 of earnings, you need to pay $15. So it's a 15 times multiple to be an owner of corporate America. Oh, sorry, this is global equities. So what we see now is that the valuation has come down. So markets has become cheaper. It's almost now at the same level we've had now during COVID. So if you think back when COVID really broke out, we had lockdowns, there was zero travel. And if you ask yourself, are we in such a dire scenario again? It doesn't feel like it. But are we as cheap as we was in 2007 after the global financial credit crisis? We don't think that there is this massive structural bubble in the market as we've had in the subprime crisis. So we think a lot of the shakeout in the market is potentially already in the price. So if we look at the outlook for earnings, this is the light blue line. This is just showing you the earnings delivered by companies and that's listed. And you can see it's already at the top end. The dark blue line shows you the margin. So margin expansion is also quite high. So for earnings to accelerate from here, either it needs to be through good economic activity or margin expansion, which we think will be difficult. But we don't see a collapse in earnings like we've seen in the global financial credit crisis. So we anticipate more a slowdown in earnings than an outright collapse. So we think the worst of the pain is potentially behind us. What's also important to understand is that the US economy is in a much better shape. So if you speak to someone who's been traveling to the US recently, you can hear that a lot of that is the economy is really very healthy. So that obviously is good in terms of when you look at unemployment levels, it is at a historical low. That's good for an economy the size of the US. If you look at the US consumer in terms of savings, you can see they've actually made up a lot of savings. So yes, we see high inflation, we see prices increase, but at this time, we don't see that it's really hurting the investors or the consumers because they've got excess savings. So it's a fine balance act for the US Fed to bring inflation under control before the US consumer runs out of savings. So these are the numbers that we monitor on a monthly basis as the data gets published, because we want to make sure that the savings level stays sufficiently high enough to support the consumer. And then just looking at the balance sheet of the US consumer, you can see here, this is debt payments as a percentage of your income. So what level of your monthly income are you paying out to service your debt? So you can see what happened during the global financial credit crisis. They were paying out 13%. And that balance sheet was restored. And you can see in COVID, it come back again. And now it's sitting below 10%. So very low levels, showing you, yes, we're seeing higher interest rates, but the US consumer is not as geared as they were during the previous two recessions. So you can see there, the recession in 2007 and 2002, balance sheets were much weaker. So if we are going to head into a recession, we think it might actually just be a much milder recession and not like we've witnessed when there was really an excess like in the subprime crisis. Just very briefly on China. China obviously is a big part of the global economy. For South African investors, the Chinese economy has got a direct influence onto the JSE, not just through NASPAS and process, but also through our commodities. China is a big importer of our commodities. China has imposed very stringent regulations in terms of property markets. That's obviously had a slowdown effect on their economy. And then they have very strong zero COVID policy in place. And we've seen that there's still been lockdowns going on in the Chinese economy. And the equity market has taken, obviously, that hasn't been good for the equity market. And it's also declined quite substantially. But I want to show you over the long term, these movements in the Chinese equity market is not unheard of. It is, however, still, if you look at the growth outlook, China is potentially still where we are seeing substantial upside in economic activity. So if you look at the graph, it shows you the expected growth for 2002, the dark blue, 2003 and 2004, 24, 23 and 22, sorry. So what's important here is you can see there is an anticipation of growth to slow down across the US and the Eurozone. In China, we actually see an improvement coming for next year and then slightly cooling down, but it's substantially higher growth than the rest of the globe. And this is potentially why it is important for us to understand it, because it might be good for commodities. Chinese consume a lot of commodities, and South Africa obviously exports a lot. South Africa, on the other hand, is still struggling. I mean, our inflation expectations, growth expectations is short of 2%. Next year, it's also short of 2%, and then it drops in 2024. These levels of growth is not high enough to address our unemployment. We need substantial higher growth levels. So when we look at our portfolio and we look at our allocations to South African growth assets, we need to be wary of the fact that we are seeing growth challenges still in South Africa. So talking about South Africa, we've had a very strong rand. So it's been painful for our portfolios because we've had a strong preference for holding growth assets offshore. And if I can go back quickly, I mean, this explains why we've had a preference for growth assets offshore, is the fact that economic growth just looks much better outside of our borders. But yet we had a strong rand. And the reason for the strong rand is because we were exporting more commodities than we were importing goods that's being utilized in the economy. So the weak economy means less demand for dollars to import goods, but the stronger economy in the overseas markets were actually demanding more of our commodities. So we had a trade balance. So if you look at our foreign trade, we had a positive numbers. So you can see these bars is showing us we were exporting more than we were importing. Then the rand actually strengthened. This little weakness here was the conflict in Eastern Europe. So it was essentially a global risk off trade, and then it came back again. So periods of rand strength over the last, you can see almost 10 years, coincided very much with our trade balance turning positive. So the strong rand is definitely not a reflection of a healthy economy. If we look at our bond market, we think South Africa bonds is an attractive investment. If you look at the yield, so this is real bond yield. So it's the yield in excess of inflation that you earn on a 10-year debt to the government. So you can see in South Africa, you'll get 4.8% above inflation. In China, you're getting less than 1%. In India, so foreign investors should definitely looking at this and seeing very attractive real interest rates on their investments. For us, we also look at the difference between South Africa bonds, so the 10-year bond versus a cash deposit, and this is 3-month deposit. The graph shows you the difference in the two yields. So currently, we are earning 6% more on holding government bonds versus holding deposits at the bank. And we think that is a big enough reward. Having said that, also is that the government finances with this commodity increase in commodity prices, obviously the government is collecting more taxes. So the government finances is actually also improving. Property, very briefly, we look at valuations, we look at the dividend yields on the property market. For us, we're trying to assess whether it's attractive to invest into listed property segments. You can see where the yields is now approaching around about 7%. If we look at historically the returns earned by investors over 5 years at different points when you invested in the market, between a 7 and 8% yield, you can see quite attractive returns. We are still slightly worried about the structural impact from COVID, especially working from home. So, and watching these numbers on a weekly basis, I think if it gets closer to 10%, we think it will be very attractive entry levels for the property market. But we are still obviously wary of the growth outlook. Then just again, looking at equities, this is a valuation measure. As I explained last time, this is a price to earnings multiple. So for South Africa, you're paying basically 13 times for each rand of earnings you earn. The key takeaway is just the fact that it's trading at levels we've witnessed last time, 2011, 2012. So it is looking very attractively priced. At these levels, you can expect to earn almost 10% per annum historically. But we want to caution our investors here because, as I mentioned, our equity market is driven by different factors. There's a large component driven by the Chinese economy. We need to look at then what is underlying the South African economy. And to do that, I've just put a couple of slides together to show why we are not aggressively overweight South African assets. So when we take a step down into the equity market, and what I'm showing you here is retail companies. So this is the likes of a ShopRite, Pick n Pay, Pepkor, Woolies is in there, Foschini and Clicks and Dis-Chem. What you'll see here, this is the earnings per share. So this is showing you how these companies' earnings have been growing. And what you'll notice is actually it peaked in 2013, and this moving average is actually coming down. So this is a reflection of our concern that the South African economy is not strong enough to sustain the earnings growth. So we can see earnings growth is coming down. Gross margins has been fairly flat, it improved, and now it's also looking like it's coming back again. So we think the SA economy is impacting the local companies. So we need very sensitive when we look at the market. We need to understand the different drivers. The next one is again looking at the consumer. This is just the likes of a Tiger Brands, Pioneer Foods, Distel. Again, I'm trying to assess the earnings growth of the market, whether it's a reflection of the South African consumer. And again, you can see it peaked around about 2011, 2012, and it's been coming down since then. And margins is also actually drifting lower. So when we look at SA equities, we need to understand there is equities that's driven by foreign factors and equities that's driven by local factors. And the local economy, in terms of the growth outlook, we think is not strong enough yet to sustain a recovery in the earnings of these shares. So our preference is definitely still much for the government bonds, where we are getting very healthy high yields. And the offshore growth outlook for us is still our preferred way to get the growth into our portfolios. That's my story. I'm going to hand over to Nadine, who's going to unpack a bit more detail in how all of this is being positioned in our portfolios. Thanks, everyone. I think we'll take questions at the end.
Thanks, Bernard. What I'm going to do today is, good afternoon, everybody, firstly. What I'm going to try and address today is the typical questions that advisors are facing at the moment and what we are discussing in the investment committees to pull it through to the portfolios and what we position, what kind of asset classes we invest in. So I think it's Bernard has touched on quite a few of these things. I'm going to do it in a little bit more detail relating to the portfolios. But the questions that we face with is, are we in inflation or a stagflation environment? He mentioned stagflation, he mentioned inflation quite a lot. We'll go into a little bit more detail around that, but that will definitely impact on what we invest in portfolios. What are the consequences from the war in Europe and your portfolio? And is it a good time to increase exposure to risk assets? So if we look at risk assets, it's typically your equities that we invest in, because at certain times in market cycles, it's better to be in risk assets, and sometimes it's better to not be in risk assets. By that, we're not saying we're timing the market, but you need to understand the environment that you are investing in. So if we just move across to a typical business cycle. So we are looking at this to understand what is happening on the ground with the economies across the world. It's a leading indicator model. We get the numbers from the OECD and we sort of smooth that into a cycle to understand, is the economies around the world in an expansion phase, slowdown, contraction, or recovery? And what you'll see here, this was the contraction during COVID. There was a very quick recovery after that. Then the economies stabilized. And what we currently see is that there's a slowdown across the world. So typically this is looking at indicators like housing permits or the building of houses. So in other words, measuring the actual economic activity on the ground to try and predict what's going to happen going forward. So this is definitely indicating to us that the economy is slowing down. And then in particular, let's see what's happening in the US. The US is currently the largest economy in the world. So if the US goes into recession, it will have an impact on economies across the world. So what we look at is typically what we call a US recession scorecard. There are 5 factors that we can look at to understand whether the US is going to go into a recession or they're not. So briefly, we look at a yield curve. If the yield curve inverts, that is an indication of a future recession in the US. More recently, it briefly inverted for a couple of days, and now it's back positive again. So it's not at the moment indicating to us that there is a recession in the short term. We look at corporate profits. So corporate profits, Bernard mentioned the earnings per share of the companies and the gross margins that the companies are still on, very healthy returns. So from that point of view, so although the cycle is definitely slowing down, the profits as yet is stabilizing and not yet falling. So we need to keep an eye on that. But if you look at that indicator, it's definitely not recession territory in the US. If we look at unemployment, I'm sure a lot of you have seen in the news flow around employment in the US being very full. Everybody's got a job, they're earning decent salaries. So from that point of view, the US is definitely not in a recession. In fact, we see a healthy consumer in the US, as Bernard pointed out earlier, and they still have some savings that they can spend. So from an unemployment point of view, we're not close to a recession. Housing starts, a very strong leading indicator. So it's definitely down from last year, but not yet at the level where we would say the US is facing a recession. So yet again, a slowdown indicator. And then the last one that we look at is some leading indicators. So it's a composite of indicators on the ground. For example, looking at the goods that's being manufactured. So if there's a strong economy, you produce more goods to sell. If it's a weak economy and there's a recession on the cards, people don't spend money, they don't have money to spend, and those kind of numbers will keep dropping. So these indicators are definitely slowing down, but it's not at levels where we would argue that there's a recession on the cards. So if we put all of this together, we are of the opinion that an outright recession is not yet on the cards in the US, but very importantly, the risks are rising. The inflation numbers, what's going to happen with interest rates going forward will definitely determine our view going forward. Looking at the slide here, we don't think in the next couple of months we'll see a recession. However, what is making it very difficult is that there are different levels of growth and inflation in an economy. Bernard alluded to a soft landing. That is obviously, we all wish for this, and that is when the Fed manage to get inflation under control, but they don't kill the growth of the economy. That's what we call a soft landing. In this environment, it will be good for growth assets, and investors will benefit from this. If we, however, go into a stagflation environment, stagflation is when you've got negative growth, but your inflation keeps on going up. So as inflation goes up, the Fed needs to hike interest rates to try and get the inflation under control. But by doing that, they're destroying the demand and the growth goes negative. That's not a great environment to be, but there are certain asset classes and investment vehicles that will do well in that environment. And then lastly, you can go into a full out recession. Technically, a recession is when there's two negative GDP numbers coming from your economy. Hopefully, we'll be able to avoid this. I think we're not there yet, as I indicated. So for now, our base case scenario in portfolios, we're looking at a soft landing to a stagflation environment. So what does this mean for portfolios and investments? Any investor in the world has certain asset classes they can invest their money in. So what you see on the slide here is the direction of inflation at the bottom and direction of growth. So that will determine the asset class that will do well in a certain environment. So for example, if you sit with rising growth and falling inflation, so let's call it this bucket over here, your developed market equity, so that's developed markets mainly offshore, that will benefit real estate, property, and credit instruments will do well. So if we look at portfolios, we need to understand where are we in this cycle. And if for a while, towards the end of last year, we were sitting in this block over here, where you would have benefited from industrial commodities, property, infrastructure, emerging market equities, inflation-linked bonds. What is difficult about this is we'll probably move into stagflation. Well, the market is definitely already talking about stagflation, but nobody is putting up their hand and say, next week or the week after that or next month, we're going into a stagflation environment and you need to be positioned in these asset classes. So sometimes you in this block and the next time you move on to another block where other investment vehicles do well. And that's the dilemma that one needs facing in a portfolio. And on top of that, we actually sit with various countries around the world in different blocks. So we would argue China's probably going into the higher growth, falling inflation environment if they get their stimulus right. The US will most probably move from this block over here to a stagflation scenario, whereas Europe and SA is already in there. So I just want to go back one slide. So if you take that into account and you look at your investment vehicles, it's quite difficult to say where exactly you want to be positioned. I'll pull it through at the end towards our portfolios, what we have done. It's not sensible in a portfolio to go and sit in cash, gold, inflation-linked bonds. Because if this scenario doesn't play out, you're going to miss out on very decent returns from equities, because over the long term, equities remain the asset class that will give you inflation-beating returns. So it's finding the balance between the one environment in the market going across to a different one. Quickly on the implications of Russia and Europe and the conflict there. Andrew alluded to that earlier regarding infrastructure being destroyed, human lives being lost. So I'm not going to focus on that. What I do want to emphasize is from an investment point of view, Europe is definitely facing an energy crisis, as mentioned earlier. Europe is very dependent on gas from Russia. And what you see on the slide here is that the percentage of commodities of global production that's coming from Russia. So it's very high. So palladium, 44%. If we go down to the table here, the percentage of Europe, the imports from Russia, natural gas, 38%, oil, 23%, fertilizers, 28%. Bernard touched on the wheat prices that we're also seeing going up. Fertilizer, they're not exporting anymore. And you all know the scenarios around fertilizer. So Europe is definitely going to face an energy crisis, which is a problem from an inflation concern. What we, however, see in this is an opportunity to actually invest in something like renewable energy. If you look at the inflation number for Europe, it's similar breakdowns to what we showed earlier in the US. You'll see a huge component of their inflation number, which is close to 8%, is from electricity and gas, and then, liquid fuels. So this component over here will have to result in Europe becoming less dependent on, for example, Russia for energy. That means they will have to invest in renewable energy projects to be less dependent. So we see from a energy independence point of view, some investments going forward in Europe. What you see on the left here is the global energy mix, and the green bar is the renewables part of that. And in order to get to that zero output in terms of the targets we've got by 2050, the portion in renewable energies will have to increase dramatically, whereas coal, which is the light blue, is going to decrease dramatically. So the number of dollars that's going to be spent in the next 10 years on energy efficiency is mind-boggling. We see this as an investment opportunity. So although it's a crisis for Europe in the shorter term, for us, we can make use of this in investment portfolios. And also when you look at renewable energy, it's an inflation hedge in the sense that you invest in infrastructure, which is typically an asset class that will sit in that block where it will protect you from inflation. The other positive from this is that commodity prices will most probably stay higher for longer. As they invest in this renewable energy projects, they will be more dependent on the commodities use. So the one I think that I can highlight is EVs and battery storage. This is all happening in China, but dependent on copper, cobalt, nickel, lithium on a very high level. So this is very good for South Africa because we are exporting a lot of commodities. However, that brings me to the South African slide, which is a little bit busy, but I'll talk you through it. And I think let's start on the right-hand side here. The blue line is the value of our exports and commodities over the last 20 years. At the bottom is the volume, so the quantity of commodities that we export. And you can see that's basically a flat line. So this number over here has really saved us. Bernard referred to our currency on the back of that. Our trade deficit is better on the back of that. So it's good for us, but the fact that we can't get more out of the ground is not great for South Africa. And that is because of structural issues like Eskom. They don't have electricity to do it. Secondly, they can't transport it to the ports and the harbors to get it to the countries that will actually need this to invest in renewable energy projects. So unfortunately, we're benefiting from it, but we could have had more benefit by being able to produce the commodities. That is the oil price, etc., that Bernard also referred to is obviously putting some pressure on our inflation number. And I'm sure you all feel that in terms of food prices and energy prices, that this will become more and more stickier as we see happening in the US and Europe on the energy side. Lastly, before I close out on the portfolio positioning, Bernard mentioned this, that on the South African bond side, we literally earn 6% more than what you earn in the bank. So this is a great investment opportunity. In the Chrome portfolios, we are overweight bonds and underweight cash in order to make to benefit from this opportunity for investors. If I can then close out on portfolio positioning, if we put all of this together, we need to get to a view in an investment committee on where we want to invest. So we call it a base case. So what would we say is the highest probability to happen? We revisit this every quarter to understand what has changed and what do we need to change in portfolios. At the last investment committee, we've put the highest probability to the fact that the US will avoid to make an outright recession. So it will slow down. We already see in the numbers that they slow down. We are assuming Europe will contain the conflict within those regions and that China will stimulate to achieve their growth target. We reference the absolute growth that is coming from China. That is very positive. It's way higher than compared to South Africa as an example. So we want to make use of this opportunity as well. If we put all of this together, how do we invest clients' money? So to come across to the portfolio positioning sector, because of the headwinds that's picking up, we would say be neutral on risk assets like global equity. However, within global equity, we're very bullish on something like infrastructure, which is an inflation hedge. In fact, we're going to increase it further. You don't want to be in private equity, so which is a high beta play. We don't own any, so we sort of tick that box for clients. You want to be overweight a quality strategy plus additional allocation to like small caps and energy and financials. We've got exactly the strategy going in our offshore funds. You don't want to be in offshore bonds where it's very expensive. We tick that box. We're not at this point in time overweight global cash and ILB. So that was sitting in that stagflation box. That will be revisited in the next investment committee now. And we've got a preference for Asia as because of their growth prospects. We've got that expressed in the portfolios. If we move to South Africa, you want to be neutral to property. We actually made the decision to be underweight because of the structural issues that were highlighted earlier. You want to be overweight bonds versus gas. That's exactly what we're doing in the portfolios. We currently neutral equities. However, we are looking for infrastructure products in South Africa to protect ourselves against inflation, and it's a good asset class as a diversifier. We haven't found that yet. So currently we are in risk assets locally, not overweight, just to where we can go. So overall, we position for not a complete outright recession in the US. However, we recognize the fact that that economy is slowing down. And with that, I'm going to hand it back to Andrew to finish the session, and we'll take questions at the end.
Thank you very much, Nadine and Bernard, for that update. As you can see, there's a great deal going on, and although the outlook is rather scary, with lots to be concerned about, I think there certainly are opportunities to take best advantage of those opportunities. I think the key issue to look at from that perspective as well is to make sure that from a financial planning point of view, that our financial planning is properly done and fully in place. So what I'd like to share with you is a couple of changes that have happened and some of the implications and consequences of that. I'm going to focus on three main areas. One is some exchange control relaxations, some retirement and estate planning developments, and then some, what I'd refer to as forthcoming attractions. I think, firstly, from an exchange control point of view, offshores can now invest up to 45% of their assets offshore. So previously, that was at 30%. Now it's increased to 45%. And I know when people have the conversation about having money in retirement fund, that was limited. With that now effectively being at 45%, and then even your local exposure, which through the JSE makes that exposure a lot higher. I think ultimately for a South African that's living in South Africa, around 45 to 50% is probably where that allocation should be. So the whole neurosis of taking all one's assets offshore, in some respects, has been pacified in some respects with this. So the key issue now is to look at it not just from a diversification point of view, but ultimately the most important is what's the overall balance to your portfolio. Having said that there's 45%, it's important to know that feeder fund structures which invest in South Africa but go fully offshore can invest up to 100% offshore. So there are opportunities where people want to make full use of the offshore allowance, and in investment structures like a tax-free savings account and or living annuity, there are some reasons why that can be effectively used, particularly if someone is living overseas and wants to receive their pension there. It's also another aspect that because of those feeder fund structures, many people who have set up local trusts in South Africa, they can invest up to 100% offshore if they so wish. That was so-called the disadvantage of having a local trust, because there were limitations. They couldn't externalize money, but through a feeder fund structure, they can now make use of that. The exchange control regulations have changed. They have, I think we can expect them to continue to evolve. And each time there's little change and tweak, and over the last year, where people had to now formalize their tax clearance because they were now fully externalizing as individuals out of South Africa. When it comes to clients are now, externalize money and their assets overseas, how they distribute and sort of allocate those assets in terms of their wills become important. So, it's important to note that if you're a local South African and you inherit money offshore, you're supposed to notify, the authorities within 30 days. Now, I'm aware that most people don't actually do that, but that is a requirement so that they are aware of that. There's been a slight development there as well with that process now, which we're allowed to inherit assets offshore, is that if you have a local trust, and if, let's assume I started investment, I took offshore, invested offshore, it's fully offshore, as an example, and she would just have to notify authorities that she's now inherited that. Or alternatively, I can bequeath it to my local trust. Now that, in essence, is fully externalized money. The trust would just have to notify that they've been a beneficiary of that, but that does create some tax and estate planning opportunities. There's obviously also the option if, I've taken money offshore and I have happened to have an offshore trust, I could also bequeath it to that. So it's important. Taxations from a tax and exchange control happen, it opens up different opportunities for us. So you need to speak to your financial planner, make sure that you understand all the implications and consequences, but most importantly, understand what you're trying to achieve and what can be done through this. I think secondly, in the area of retirement and estate planning, this is a space which has seen a number of changes, and I think will over time continue to see a lot more. The first one was the SARS were struggling to try and maximize their income. If you were receiving a pension, then in essence, that pension was taxed on the pay-as-you-earn tables as you were receiving them. But now SARS has decided that they need to look at multiple streams of income and all your income. And when you look at all your income, they're now adding that together. So you're not paying pay-as-you-earn tax just on that one income stream, but a collection of them. So the reality is SARS is now collecting a lot more tax. So in most instances, people are now overpaying tax and would need to claim back from SARS. So SARS have been very clever with this, is that they're helping their cash flow rather than yours. So it's important that you speak to your financial planner, make sure that you're paying the right amount of tax, so you're not overpaying and then having to claim back that money from SARS. But through this, they've actually opened up another opportunity, and that is the opportunity to purchase multiple annuities. So in the past, when you were buying an annuity or pension on retirement, you only could buy one. Now you can actually buy multiple annuities because they're aggregating, whereas previously they didn't. So slight disadvantage, but with proper planning, not a disadvantage. And the key thing now is with the availability of multiple annuities, it's something that we all should look at. And bear in mind, with annuities, you can have a living annuity where you take on the risk and you determine the amount of payment between 2.5% and 17.5% and invest the money based on your requirements. And then there's compulsory life annuities that the insurer takes on the risk and they pay you. Now, previously, you had to make a choice at retirement on which of those options are. With these developments now, it's something that you can split your annuity. A component can go to buy a fixed compulsory annuity and the other a living annuity. And as you're getting older and as the interest rate cycle changes, so at some points it might be a lot more attractive to minimize your risk and take a compulsory annuity option. So that's certainly something that I would recommend that you have a look at and constantly look at. The final issue on retirement and estate planning is in the area of estate planning. Unfortunately, the Master's Office has seen many delays. We have a number of clients who are struggling to get appointed as executors. We have a number of situations where trusts, where they need amendments, those things aren't happening. So with the administration of an estate, it is causing a lot of delays. So important estate planning is now even becoming critical to ensure that there's liquidity in the estate. So as you're looking at your will and the estate planning around that, make provision for potential delays in the Master's Office and ensure that there's more than enough and adequate liquidity. There are ways to bypass the estate with beneficiary nominations, so ensure those are done. And with efficient estate planning, that you're fully utilizing all the options available through living annuities as one example. Firstly, they're not taxed from an estate duty point of view, and they ensure ongoing liquidity within an estate, and it's effectively bypassed from the executor. And so in terms of a fee point of view, as well as an accessibility point of view. So that's by and large always been there, but I think is now becoming more and more important. And then moving on to my final slide, what I call forthcoming attractions. There's been a lot of talk and some investigations being done again in the space of retirement funds to allow people early access. So those people who are struggling to get by on their monthly living expenses or have other needs and challenges from a health point of view, etc., that they can potentially access their retirement funds before retirement. So at the moment, that's not possible. To access your retirement fund, you have to either be 55 or terminate your employment. So they're looking at creating a two-pot structure. So they'll take, if you've got 100 Rand in your retirement fund, they'll take 1/3, which is the 1/3 you can access at retirement, and say, well, that's a portion that you can potentially access during your working life and before age 55, where previously you couldn't, and then the other 2/3 will remain there for you as a pension when you eventually retire. So this is something that's being currently investigated. It has many systems implications. It has a number of other implications and consequences, but the authorities are currently looking at it and have indicated that this is likely to be introduced in the near future. So I think that's, for some, a potentially positive development. Obviously, the consequences of accessing that money and continue using it means that you don't have it in retirement. But if you can't cover your costs and live now, and particularly if you're being responsible about it and it's essential, then there certainly are benefits, but there are certainly long-term consequences of that. The next is in divorce orders. Now, without going into too much details, there are sort of two marital regimes in and out of community property, and prior to 1984, you couldn't, if you're out of community property, there was no accrual system, and then that was introduced. And after 1984, you had an option if you say, I'm married out of community property with accrual or without accrual. And if you agreed then without accrual and you got divorced, then the one spouse who had the assets, had no obligation, and there was no right for the other spouse to get any share of that. A recent court case in the Gauteng High Court said that's unconstitutional and it's unfair that a spouse with all the assets that have been accumulated while they were married, even though they had contracted for it, should be prejudiced in that regard. So they've said, the spouse, in this case, Ms. Schreling, who was a farmer's wife, assets had grown massively and they separated, and she was entitled to none of that growth. And so the court found it unconstitutional. It's now gone to the Constitutional Court. So there's no final decision on that, but this is something I think that has a huge impact on a number of people, and we'll look at it very closely. The other thing is other assets. I'm not sure whether I have too much favor in calling crypto assets other assets. As you can hear by that mirth, I don't believe they're an asset at all, but they're certainly not an investment because they don't generate any income. But currently, they're being looked at, and our regulators are looking to see, whether they can build some regulations around it. But I think it's important to note that the retirement fund industry has effectively outlawed a retirement fund from having any crypto assets in them. But the FSCA, the Financial Service Conduct Authority, is saying, well, if people are going to access these, what are the rules, the parameters, and the dynamics around it? And the taxman is also having a good look and see how they can get their fair share out of those as well. And then I think finally, infrastructure investments, there's a lot that's been done. And as you heard from both Bernard and Nadine, something that we've looked at quite extensively, where you have an infrastructure asset, whether it's a renewable plant that has a reliable, consistent sort of income stream, and it is a very stable, secure investment. And certainly where we've allocated some assets to that, both locally and globally, there've been good opportunities with that. So I think we're going to see more and more, and the Regulation 28 of the Pension Fund Act has been amended to make more extensive and appropriate use of that, and within the portfolio, within certain parameters, there certainly are a number of benefits for that. So I think these are all things which one needs to be aware of, needs to look at your own personal circumstances to see as and where and how they may be applicable. So please do have a look at those, have a discussion with your financial planner and see where and how that may impact on you. That's it from my side. So thanks very much for joining us. I'm going to now just move over and see if there are any questions. So if anyone does have any questions, please do put it on the question or on the chat, and combination of Bernard, Nadine, and myself will attempt to answer them. So again, thank you for your time, but we'll hold on for a moment or two just to see if there are any questions at this stage. I don't see any.
Yeah, Andrew, there's one question. There's a question regarding our view on India versus China. So I'm quite happy just to answer that very quickly. So we utilize two external investment managers that specializes in emerging Asia investments. One is Bailey Gifford, the other one is Schroders. And when you look at their portfolios, or well, via their portfolios, we are getting access to India equities, and both those managers actually have a bias towards India. So they're holding more Indian assets than Chinese assets. So we think the outlook is very promising for that market, but at this stage, the best way for us to get access to those investments is by utilizing external investment vehicles. But it's definitely in our portfolios.
Bernard, maybe just to you and Nadine, with regards to the talk about recession, why is everyone so fearful of recession and believing that it is a lot more imminent than the two of you have indicated that it would be? So, you see on the news daily, is it's just news hype, where I think your indications are, that yes, the risks are there, but they are, not as significant.
So when you look back in history, obviously in a recession period, your growth outlook deteriorates. So equity market movements of 20% down, like we've experienced now, normally coincides with a recession. So that's why obviously why investors are concerned, because they are concerned about the impact on equity markets. Why we think it might be a mild recession, if there is a recession, is the fact that the US economy is very strong. So if we go back to the global financial credit crisis, obviously there was a structural problem in the market. I mean, the collateralized debt obligations where they package house mortgages together, it created a bubble in the market, and that asset bubble needed to deflate. We don't see that asset bubble in this market. Yes, crypto and the meme stocks, some of these high technology companies, there was a bit of a bubble in that segment, but it wasn't the frenzy we witnessed during the dot-com bubble where everybody was buying technology shares. So the Nasdaq is down by 30% already, but it's the impact of that is only to a small portion of investors that was going into crypto in these high-flying, expensive assets with no revenue growth. So we think the US economy is quite strong. They need to bring down inflation. So interest rates will start having an impact, but there is no structural problem in the market that needs to get deflated. So when we look at those blocks that Nadine put up there, and how we frame our decisions is almost trying to establish is where are we and where do we think we are going? And between those two, we try to build a diversified portfolio. And then the other question is, where are we not? So we are not in an environment where we think growth is going to accelerate further. So you can almost take 2 blocks out and put 2 blocks in. And then that's how we try to bring it all together. This fear about recession, I think many people think back about 2007, because that was the last time we had a proper deep recession. And we just don't think that's where the market's at. So equity market is down 20%. Do we think earnings is going to fall 20% when you're running at full employment? Balance sheets are looking healthy. I can't see it's going to fall more than 20%, even if it's going to be that high. So that's why we are still saying it's not an environment where we're going to go put and all sit in cash, because cash is not going to give you your inflation beating returns. It's trying to get that balance right between the growth assets and the defensive assets. And we are seeing opportunities. So the infrastructure we think is a great opportunity. We've brought in some commodity exposure. We think that's going to be a great inflation hedge, and there's potential upside for mining companies to generate earnings. So overall, we are not as concerned in terms of the recession risk that the market is. Sorry, there's another question. Let me just... Right, I'll take the answer on infrastructure. So infrastructure, obviously, when you look at our economy, it is taking strain. I mean, our economy growing below 2% is not sufficient to make a dent in unemployment. I think the government is making the right noises in terms of getting private investors into the infrastructure space. I'll give you a practical example. We've made for our own partners investments into South African infrastructure, and we're looking to do another round. So we are utilizing our capital to support infrastructure in South Africa. When we look actually at the latest round of the bid window, where you can actually go out and you can bid for projects, I think it was 20 times oversubscribed. So there's a lot of private investors, private capital that's keen to invest into infrastructure. And the fact that the government is now opening up the opportunities for private companies to make use of rail, to put on their own rail, to make use of the energy. I mean, when you speak to the executives at the mining companies, they are all planning to put on their own energy plants. So we might find a solution for it. So the Eskom is slowly gonna lose its grip on the monopoly they have. But it's just taking much longer, I think, than what we as investors would like to see. So we think there is definitely, pardon the pun, there is light in the end of the tunnel, because we are seeing the private investors is coming to the market and solving many of these problems.
Should I maybe talk about the China stock prices?
Yeah, please.
Just briefly, so right at the beginning of the year, when the US market started to fall, the Chinese stocks actually held up a little bit better. And then all of a sudden, towards the end of Q1, we saw that massive fall in China. So if you look at any emerging market index, China was much more down compared to the other emerging market indexes. But that wasn't based on valuations. As the question mentioned, they were actually cheaper than some of the other regions. However, that was on the back of the regulation challenges and the uncertainty around the technology stocks and the regulation around that. They are also their zero COVID policy was having a bad impact on the sentiment in China, because that is obviously also having an impact on supply issues, on the growth numbers coming from China. And on the back of another factor for China is that towards the end of this year, they're going to go through a potential change in terms of politics. We don't think there will be a leadership change, but they are expecting changes after what's going to happen in November there. But I think that's secondary to the other 2 points that was driving markets down.
Yeah, so the Chinese equity market is, I mean, you're right there in your comment, is, I mean, the market's fallen by 40%. From a valuation perspective, it's probably one of the cheapest markets out there. The global investor is very nervous about China, and there's comments about whether Chinese stocks are investable. We still believe in the long-term case for Chinese economy. It's the second biggest economy in the world. There are a lot of great businesses out there, but it was definitely that sentiment towards Chinese stocks was very poor from the foreign investors. When you look at, for example, not sure if you're familiar with the fact that there's certain stocks that you can only buy if you're a Chinese citizen, and then there's the stocks that we can buy as foreigners. And when you look at those two baskets of shares of the same, essentially same economies, you'll see that the foreigners were selling much more aggressively down than what the locals was actually. So it's showing us that there was a bit of a sentiment towards the Chinese economy that was driven by investors just saying, well, we aren't certain about the outlook for this market. We don't understand the regulations. So they basically just dumped a lot of the shares. If you look at the fundamentals, and we do a lot of work on the underlying fundamentals, there's some great businesses out there and they're growing. It's a growing economy. So we do think it's an important part of a portfolio. In our Chrome portfolios, we're basically neutral. We've been a bit overweight before. As of today, we're basically on par with the benchmark, but we are definitely think that it should be part of a portfolio.
I think we lost Andrew.
I think we've actually also investing into fiber infrastructure. So I think Andrew will be glad to hear that as well. Then. All right, if there's no more questions, I mean, if you have questions, I think you can also pass them on to your advisor. It will get to us. So we're happy if you've got answers you don't want to put on this forum, if you want to mail them through to your advisor. But that I think we was due for an hour, this meeting, Nadine.
Yeah.
Okay, so we are a bit over. But yeah, thanks everybody. Appreciate your time. Can't believe it's been a year since the last one. But yeah, thank you very much. And we'll see you next time.